Hello and welcome to another edition of Nucleus Investment Insights. Today we'll have a look at the Aussie dollar. So it's been a bit of a nosedive the last few months, but showing a few signs of life in the last week or so. And so we thought it well worth grabbing Dave and having a look at the Aussie dollar drivers, the key drivers for it. Just a quick reminder, everything you hear today is general advice in nature. It's not personal financial advice. If you do want to get personal advice, then jump on our website, nucleuswealth.com, and we can have somebody talk to you about what is right for you. So with no further ado, let's bring in Dave. Dave, how you going?
Good, thanks, Damien. Happy New Year.
Happy New Year. You look like you're very Scott Morrison-esque with a nice Hawaiian shirt there.
Yeah, well, I thought, still the silly season, so might be a bit calypso. So anyway, given we're fast headed to becoming a banana republic, it probably has some signal to it.
That's right. Yeah. Right. So just a reminder, actually, sorry for everyone, if you've got any questions, pop them into the chat. So I think it's probably worth just sort of going through what the five drivers are, and I guess sort of a quick overview, and then we'll jump into looking at each of them individually. Dave, I'll hand over to you.
Sure. So anyone who reads my stuff regularly will understand these are my major touch points in looking at the currency. The terms of trade, which is the ratio of export prices to import, and that's really, for the most part, commodity prices, and within that, the bulk commodities being most important. So things like iron ore, the two coals, gas, etc. Interest rate spreads, where Australian interest rates, what level are they versus other countries and other economic zones, and is that difference positive or negative, driving a carry trade, either out or into your currency? Global versus local growth is quite important to the Australian dollar. Strong global growth definitely gives an impulse for foreign capital to pour into Australia on the basis that, that will drive up commodity prices, etc. And if we have weak global growth, then that's a deterrent to putting money here into things like equities, and so that ratio again, I guess, counts for where capital is flowing and affecting the currency. Positioning and sentiment, these are much more dynamic short-term measures, but they are important in terms of sharp moves. So we'll take a look at some of the measures that indicate where everybody is sitting on the Aussie at the moment. And the US dollar, of course, the relative value and power or weakness of the US dollar is very important to the Aussie as well. Obviously, in terms of the cross with the US dollar itself, also the impact that the US dollar has on commodity prices, etc., which has a sort of ripple effect into the Aussie dollar. So we'll just start from the top, I guess, with
straight into terms of trade.
Into terms of trade. So I've got the chart here, and for those that can see it, we're still enjoying a pretty incredible level, only just below the pre-GFC super boom. And that was largely driven, by the stimulus of COVID, and then in particular afterwards the Ukraine war and all of the disruptions to commodity supply chains that came with it. It is now deflating at a pretty good clip, but is still very high. I guess this is the point we need to make, and so there is a lot of income still flowing into the country, which is keeping things like the budget, quite well reflated, and some, reasonable kind of levels of mining investment as well, because this is largely a discussion about commodity prices. And so in general, with the terms of trade this high, you would actually expect the Australian dollar to be really strong. Like the last time the terms of trade were this high, the Aussie was probably at 90 cents or so, or thereabouts. So, remarkable divergence this time between the terms of trade and the value of the currency.
I guess some of that's the like the massive growth we've seen in terms of exports of gas, and the fact that we neither make any royalties from it, nor are they owned by Australians, and so it's sort of money in and then money out.
I'm not sure you can call it an export, therefore.
Yeah, that's right.
The theft of gas is playing a role here, because it's certainly driven up in terms of trade and dislocated it from the actual impact that it used to have on the economy. So yes, certainly a few points of it would be in gas.
Yeah, and because I mean, even if you looked at the gas that was being sold, in the sort of towards the financial crisis, it was largely Western Australian gas, which did have royalties on it and all that type of stuff like that. And so whereas then you get
probably I guess 5 to 7% of that terms of trade is probably gas.
Yeah,
roughly around that. So it's significant, but it probably doesn't change the story. But it does exaggerate it, definitely.
Yeah.
The really big indicator is the bulk commodities. With iron ore still at up over like $105. Coking coal is at about 190. Thermal coal 120. All these prices are still well above. They're actually not far above the budget forecasts now, and all of them are expected to keep falling through Q3 in the budget to $70 thermal, 150 coking, and 70 iron ore, 80 thermal actually.
And just a reminder, I guess, for listeners that when you hear about trading and you listen to markets, like it seems like gold's really important and copper and a few things like that. But actually, when you're talking about just dollars in the door, iron ore and coal just dwarf everything else.
They do, yes. But although gold is also a significant player, just not big enough.
Yeah,
nothing like the bulks. The bulks are like 50 to 60% of the overall terms of trade. So they're everything.
Gold you can probably remove 1 0 from the effect, and most others you can remove two or three zeros.
Yeah, that's right. So if the budget forecasts come to fruition, I think that they're reasonable. I might not be quite so bearish on iron ore, but pretty close to it. I don't expect a good year. Maybe not quite so bearish on thermal, but in short, I think the budget's right, and so we'd see that terms of trade ratio really get hit hard this year. I would be looking for it to drop, well below 80 by the end of this year, and so that's obviously a significant headwind for the Aussie dollar, and I expect that will get a lot worse in the subsequent 2 years as the bottom basically falls out of iron ore. With the arrival of the Pilbara killer, the Simandou mine, ongoing weakness in China in its construction sectors and falling steel demand there, and just supply coming from all directions for iron ore. And I'm looking at a market balance, a swing in the market balance in iron ore of like 300 million tons that's going to need to be like squeezed out. So $50 iron ore in 2026-27 seems to me entirely plausible, in which case we'd be really starting to get down towards, the 2015 lows that we saw for the terms of trade, and that will be chaos when it comes for things like the budget, national income, nominal growth, interest rates will get smashed, and the Aussie dollar will not like it.
Well, it's already Aussie dollar already hasn't been liking just the prospect of the. I mean, we've done a fair bit of the move already. So there's a question in there, which sort of I was going to get to later, but actually it is a little bit related at the moment. Just asking about whether there's from to infinity and beyond. Just asking if there's any industries in Australia that might actually benefit when it stays low. And I mean, I know I've got a couple from an investment point of view, but I'll hand to you first, Dave, for who benefits.
There's all the US dollar, the non-mining US dollar earners.
Well, even the mining companies benefit, but if it's
the mining companies benefit, but they're also weak. So
if the iron ore price falls from 100 to 50, and the Aussie dollar falls 20%, it only cushions a blow. It doesn't.
Look, we still have a few. We still have a few. Yeah, I mean, there's some tech that ResMed, this type of company with big US dollar earnings.
CSR,
Amcor. The old school industrials that have global supply chains and sales. These are all winners in this scenario. For sure.
And the other big picture one is that, and sorry, actually, let me go back to the Aussie ones first. And there are a lot of the ones we tend to be relatively heavily invested in our own sort of Aussie portfolio. The other thing is to think about is that, look, this is part of this reversing the Dutch disease. So when the Aussie dollar is at 80 cents or 70 or 80 cents, and you just say it's just a services company, it's a KPMG or someone, and they're looking to put on somebody in Asia, then they're more likely to hire somebody in Japan or Singapore or Hong Kong or something if the Aussie dollar is high. And when the Aussie dollar is low, all of a sudden it's like, oh well, it's for the same salary, it's now actually costing much less on a global basis. I might put the person on in Australia. And so there's just a million of those tiny decisions from global companies who just like a little bit more in Australia, and that sort of helps through the recovery. So a lot of this is just a necessary reversal of the Dutch disease. When all these commodity prices go high, the opposite happens.
No, exactly right. And perhaps the Canberra disease as well.
That's right.
Markets might be able to help us out there. So I guess in summation, if we're looking at this in terms of 5 drivers, the terms of trade is still actually a real positive, but is going to get increasingly negative over the next 3 years. So definite headwind. So onto interest rate spreads, and this is one reason why we simply have not gotten any terms of trade lift for the Aussie dollar, because the interest rate spreads are so low, especially to the US.
Actually, let me just explain interest rate spreads. What we're talking about here is the difference between the Australian yield and the US yield.
Yeah.
And so on the chart which we're showing, just for anyone listening in, if you're talking about, let's say, pick the 5-year, or actually I'll do the 10-year, which is sort of a longer term to look at it. For most of the, we've got sort of a 25-year chart. For most of that 25 years, the Australian interest rates were 1 or 2% higher at least than the US ones. And that's sort of a reflection that Australia's got a higher inflation target, which is part of that, and also the expectation is that it needs some. It's a bit riskier, and a lot of and so you need a little bit more yield to sort of attract investors into the Australian economy. But at the moment we've sort of backed down to negative spreads at the moment, where Australian interest rates are lower than US.
That's right.
Just mildly negative.
And I mean, to get a notion of the importance of this, you look at 2011, when the 2-year spread was nearly 5%, and the dollar was like $1.10, $1.11.
Yeah,
like nearly double today. So it's a very significant driver of the currency. So what do we expect on this front? Well, another headwind actually. So, I mean, we're in this kind of US exceptionalism boom worldwide, and that's now, led to the Federal Reserve backing off its interest rate easing cycle. Now that the Trump administration has come in with its fairly inflationary agenda. So, we've had a recent narrowing in these spreads because the Fed is not going to cut much more, maybe one more, and then pause. How long that pause will last, we'll have to wait and see, what impact these policies have. I would expect probably a few more cuts, once it all settles down. But for the time being, it's definitely, headed towards more hawkish rhetoric from the Fed. And on the other hand, the RBA is, growing in confidence that it has beaten inflation here, even though it's been obvious for about 6 months that it was beaten. Their confidence is growing, and my forecast is a February cut. I think 3 or 4 cuts during the year. So these spreads are under pressure for Australia. They're likely to get more negative. So this is another big headwind.
And I guess in terms of what you're saying as well, in terms of exceptionalism, there's you break the world into a few different parts, and you sort of go, well, there's sort of the Japan and China, which are, deflationary and sort of Japan to a lesser extent, but certainly China sort of big debt overhangs and things like that. And so it's sort of got their interest rates are really low. You've got Europe, which is struggling for growth. And so you're sort of sitting somewhere in between the US and China, for example, for Europe. And then you have the US, as you said, US exceptionalism, the growth's still pretty strong. Looks like the interest rate cycle is going to be a pretty shallow interest rate cutting cycle. Everything looks pretty good. And so the question is, is Australia, and actually, I guess the UK sits pretty close to the US in terms of where their sort of interest rates are and everything as well. But then Australia sits right up there as well. And the question is, is it as strong as its peers? And is it at face value? You wouldn't think so. It would seem Australia's more just it's delayed cycle rather than much higher. But I guess we'll see what if we keep getting politicians making decisions to keep inflation high, then I suppose it'll be self-fulfilling.
Well, yeah. I mean, we could get into gas, but maybe we should avoid that.
Yeah.
So the third driver is, sort of relative growth prospects. And this is not a good one either for the Aussie dollar. We've had a very weak local economy, basically an entire political cycle of per capita recession. In part because mass immigration was driven so hard, and this was a perpetuation or a return to this labour market growth-led model that the coalition had pioneered at the end of the mining boom, around 2013. And this model, it has its pluses and minuses, but the plus being it creates a lot of jobs, but unfortunately it tends to create really crappy, low-paid jobs.
Yeah. Well, and I think there's a bunch of other pluses, but I think we've hollowed out every possible plus over the last 20 years that we possibly could, and
we have, yeah.
There's little incremental left.
So the bottom line now is it's largely negative for growth, certainly in per capita terms, but because it's destroyed productivity, it's pretty negative for growth overall. I suspect that rate cuts will be pretty slow to lift activity next year as well. There's a terrific chart I put up today from CoreLogic showing the gap between affordability and prices, and it's the largest it's ever been. And so, we really do need much cheaper debt to get a lot of movement in house prices, and so you're not going to get a winning consumer for a while.
Yeah, well, and that sort of depends upon how much you equate higher house prices as being good activity as opposed to bad activity.
Yeah, well, obviously it's not good activity. I'm just talking about activity.
Activity, yes.
Any kind of activity.
Yeah.
This year it sees a peak in a lot of the state government spending and the infrastructure spending, so that comes off. So, you're going to see modest at best real income growth with, again, immigration sitting on wages. It's just not a great story. The Australian rebound will be soggy and weak and very likely to underperform everywhere else. So again, big currency headwind.
Yes, and actually, it was just a quick throwaway line, but it was worth pointing back to another podcast we did. Just David spoke quickly about the productivity differences. So just before Christmas, Leith and I did a whole podcast on that. But yeah, that it was that the real upshot of that is that in the US, their productivity is booming, and a lot of the discussion is about trying to understand why productivity is so strong, and Australia's got exactly the opposite problem.
Yeah, which is unusual. Like those trends tend to trend globally. It's unusual for such a divergence among developed economies. And I think the embrace of that immigration-led model by Canada and Australia has certainly played a significant role, and to some extent in the UK as well. Excuse me. Whereas the US is, going through, your typical, business investment-led growth with booms across all sorts of sectors, and which you would expect to deliver productivity growth. So needless to say, all of those headwinds have created pretty negative sentiment for the currency. One of the reasons I was so bearish on the dollar, just kind of get through December, was, you can see on the chart here, there was a period during which the Chinese stimulus euphoria was happening, where the market got long the Aussie dollar, and I was like, oh my God, for real? And as all these incredible headwinds were coming to bear, and I was like, man, that's just the best setup I've ever seen for a short Aussie dollar. So anyway, that's come true. The long did not last long, and has now crashed to quite a deep short on the CFTC measure, which now makes it quite difficult to push it lower, because we've got a lot of bearish people already in the market.
Actually, apologies, I haven't actually got that chart up, Dave. But yeah, that's just sorry, I haven't got that one with me. But yeah, so basically that's just looking at the what traders are doing in terms of the
exactly right, and they're bearish. They're bearish now, the Aussie dollar, which is bullish for the dollar. So that's good.
So sorry, you should just explain that quickly, Dave.
It's just when you get that much negativity around an asset, there's a certain point at which you might get a bit of good news. You've got a lot of negatives priced in, and anything that falls on the better side of those expectations will deliver an outsized move the other way, because there's lots of people have got to cover these bets and buy the asset.
And the other thing is, there's a lot of momentum traders out there, and so when the Aussie dollar started to fall, they then piled in. And then as it kept falling, they kept buying more, or their positions just got larger. Even if they didn't buy more, they just got larger because they're making more profit out of it. And then it sort of hits that once it starts to move in the other direction, there's a lot of these traders they're not doing it on anything except trying to chase that momentum, and just say, okay, it's stopped. Let me take away the profits that I've made, and I'll go play somewhere else.
Yeah.
Actually, just before you go to the next one, Dave, I might just jump in for a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So that was that was global. So we've done the global growth, done the traders, and so up to the fifth. All right. I jumped one ahead?
No, we've done positioning and sentiment, basically. I mean, the other big thing to note on sentiment is, the Trump agenda, has front run a lot of the Trump agenda. That's a very bad way of putting it, but the Trump agenda has been front run in markets. So, sentiment is partly so bearish because people are expecting more Aussie dollar negative news on the Trump agenda.
Right.
So sentiment is very, very dour for the Aussie. And now there's a pretty good jumping off point to our fifth driver, which is the US dollar. The same sentimental driver has massively overbought the US dollar because the Trump agenda of tax cuts, tariffs, mass exportation or deportation of illegal cheap labour,
Lots of government
all
spending.
pretty inflationary, and then you get on top of that, like Trump himself, who's obviously a pretty volatile character and throws up lots of geopolitical questions. So you get a safe haven bid, and so it's and the Fed backing off, and it's just a one-way bet, or has been, the US dollar on the basis of all these things. It's like 50-year highs, something like that, the US dollar on the trade-weighted index. It's certainly high enough to do some damage to the economy. And what typically happens when you get a big overshoot on a currency like this is it does just that. Kills off your exports and some national income, and suddenly you find your economy weakening, and you might need some extra rate cuts, and so your currency comes down. And at this point with this positioning, there's a risk of that with the US dollar.
Well, and actually, there's just a quick one from one of the Infinity and Beyond. Another question there that's very apt for this is that, how much of this do you think is, or what's the potential, I suppose? I'll rephrase that question. What's the potential you think that some of this is buy the rumor, sell the fact, in terms of, as you said, it's front running the trade, and then now Trump's in, that US dollar strength reverses as people sort of take their profits and sort of move on to trying to front run this next
big risk. I mean, that's going to be one of my conclusions.
Right.
Is everyone's on one side of the boat here.
Yes.
So definite chance of it tilting the other way. Now, the narrative is still very strong for the US dollar. Like things like the stuff we've discussed over the last kind of 18 months with its productivity super boom, which appears to be like well underway. Weight loss drugs, AI, autonomous cars, drill baby drill, like these things are all like, crazy good for US growth. It's not that the US exceptional narrative doesn't have real roots, it does. The question you've got to ask is precisely that one, has it all been priced in and front run? For the time being, I think the answer is yes. Like, I think it has priced in a lot of stuff.
So we're talking about the US dollar.
Yeah, like I think the US dollar is priced in a lot of the bullishness.
Positivity. Yeah.
And so there's a real risk of a reversal, like for a while, anyway. There's a big unknown in this, and that's Scott Bessent, who's the Treasury Secretary. How much influence will he have over Trump? How much can he shave the sharp edges off the Trump agenda? There was a leaked piece a week or so ago about making tariffs incremental to make sure that they weren't overly inflationary. It looks like his immigration or his deportations will actually be a John Howard bait and switch just into legal immigration with green cards, for everybody, apparently. So I don't expect, it looks like they're going to try and sit on any wage inflation with that. And, then you're down to your tax cuts. So, if Scott Besson, who is a hedge fund trader off Wall Street and knows the markets well, especially the power of the bond vigilantes who have actually been driving up yields and freaking out markets until a sort of week ago when some of these positive leaks came out. So how influential will he be over Trump for what sort of enduring period? Like if Trump just gets loose and he could start shooting himself in the foot, get in his own way and drive the dollar much higher. Like if he really goes crazy on 60% China tariffs or whatever.
Yeah. Sorry, I should actually explain as well, just for anyone, especially our younger listeners, the John Howard-esque comment is basically what David's saying there is there was a Liberal Party basically took illegal immigrants and demonized them and locked them up and all this stuff like that. And at the same time, though, threw open immigration massively to levels we hadn't seen before. And so it was sort of like this to their party. They were like, look, we're anti-immigration. Look how terribly we treat these group of people. Whereas in reality, they just threw it open and for companies that was great for getting cheap labor and for wage earners in Australia, it was poorer because you didn't get as because more people competing. And that's what we're suggesting is likely in the US, that you'll demonize the illegal immigrants and particularly drug dealers and whatever it is, whatever other examples you can have of illegal immigrants behaving badly, and in the meantime run a larger than ever illegal one. And I guess the issue there is some of the MAGA movement, in particular, say Steve Bannon, is dead against that, and he's out sort of actively trying to undermine Elon Musk at the moment for that reason. And so that's one of the ones we're watching in terms of saying, well, if Steve Bannon wins that fight, and I guess the popular view, then you're looking at higher inflation.
Yeah.
But our expectation is no, it probably won't. It'll probably be, I think as you might have written, I think maybe today or yesterday, David, it's the difference between populism and being popular is that the idea is that the populism is you get voted in by people telling them you'll help them and increase their wages, but then you sell out to the corporates and bring in lots of people anyway.
Yes, exactly right. So, I mean, this is a real watching brief, isn't it, on the US dollar? Like, if the Trump gets it right, probably the impacts are all priced in. If they get it wrong and they overcook it, then it's going higher. The one thing that we haven't really discussed here, and maybe this probably harks back more to global growth, is the role of China in this.
Yeah, we've got a bunch of China questions as well.
Right. Yeah. And I think the big, if Trump just does a 10% tariff on China, which he was talking about today or overnight or the last couple of days, then I'd say that's priced. But if it becomes incremental and it becomes another 5% every month after that, I say anything above 10% would start to trouble the market again, and the US dollar will keep rising.
Right. Well, see, that was one of the questions, and actually something I'm interested as well. So, is it? I'm going to try and guess that the user, but they're saying, what's the upside of tariffs, between 0 versus 20 versus 60. So he's spoken about 60. I think I was seeing there might have been a Goldman one out today. I think he posted was just saying their expectation was 20, and that was what they thought most people had factored in.
Yeah.
But you're saying you think it's the expectation is lower, and so and I guess what I mean by this for people is that it's very hard to work out what's really going to happen, and I guess if everyone thinks, well, he says 60, it might be 20, and then it comes in at 40, then the market's going to react negatively.
Oh yeah.
Whereas if it comes in at 10, they might react quite positive because it's lower.
Look, I think what is priced is roughly what he's mumbling about, right? Somewhere around 10, maybe 15. I think if you started talking 20, the US dollar would take off again.
Yeah.
Not just because I don't think that kind of impact is priced yet in the currency technically, but because the market would be like, well, shit, this is this has only just started.
Yeah.
Or we'll start pricing 30 and 40. I mean, there's a real tension here between campaign promises and what appears to be a genuine belief on behalf of the president in tariffs, and his desire for a golden age. Like, he wants a boom. And a currency that's this strong does not generally give you a boom. And Scott Bessent, in his last newsletter before he effectively quit to become Treasury Secretary, said precisely that. Like, if we want to have an industrial boom, we need a low dollar. And so there's going to be voices in the camp that are telling Trump this, but of course, he is now delivered by God into this position. So I don't know how much he's gonna.
Yeah. And he does seem to oscillate.
He is a freaking nut.
But he does seem to oscillate between wanting a lower dollar, and then when someone mentions something about a strong dollar, he's like, "Well, that sounds pretty good, doesn't it? Don't we want a strong dollar? Isn't that the dream?"
I mean, what's he gonna do with crypto? Like, it's volatile around the man, let alone the policy platform. But to answer the question, I think more or less what Trump is talking about is in the price now. 10, 15%. If we get any sort of ruminations above that, then I think off we go again.
Yeah. Actually, I'm just going to jump to one more sales message, and then we'll come back and talk a couple more questions and wrap it up.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So, so coming back to a couple of the questions we had. So there's, I think there's a couple on China, and probably the one, I guess probably the overall perspective is, well, this one's probably not, but sum it up. So, how much of the weakness in Australian dollar has been about sort of expected Chinese weakness versus versus domestic conditions?
Significant. Yeah, I mean, more significant sentimentally than actually, because as we saw, the terms of trade have not fallen certainly as much as I would have expected, given the scale and duration of the property crash. So a lot of that is sentiment about a balance sheet recession taking hold in China, I guess you would say. Japanification is another word for it. The fact that they're trapped in secular slow growth, which they are. They used to be called depressions. These days, through various kind of, liquidity measures and fiscal spending and stuff, it doesn't get that bad. But that's effectively where China is. It's a long way from over. I think the Chinese desperately need a lower yuan. But of course, they're running, up against Trump and his agenda to unravel Chinese export leadership. So, my primary risk for the Australian dollar to go lower, to go even lower this year, is China, and it is that the yuan starts to break down, because I think that would take the Australian dollar down with it. That's probably possible without the US dollar taking off. Excuse me. But it plays into the politics really badly. And so you could get into a loop really, really quickly with falling yuan and rising tariffs, which would be a doom loop from hell, which is why I think the Chinese are trying to protect the yuan as much as they can. And by doing so, they're actually entrenching deflation at home.
Yeah. Well,
so,
and the other one is
they're just trading evils, basically.
Yeah, and the other reason for keeping it a little bit stronger than rather than weakening is because China, one of the biggest problems in China is they need to get money from their business sector across to the household sector.
Yeah.
And with a lower yuan, then households can afford to buy less from overseas, but businesses can now export more cheaply. Whereas if the reverse happens, when the yuan goes up, you get that. Yeah, it's harder for businesses to export, but it's better for consumers because consumers can now afford iPhones for cheaper.
I mean, we have seen an interesting development in China in the last few months on how they're going to stimulate consumption. Like they've been using all these trade up programs, you take
cash for clunkers type stuff.
Yeah, cash for clunkers. So in other words, they're not going to shift any income, right? And they're just going to give away food stamps, more or less, right, and still control it from the center. So it's not really consumption. It's not sustainable and it won't work, but they're going to give it a crack.
Yeah. Well, and it's hard to say as well how much of that is about stimulating consumption and how much of that is just about trying to, I guess, use their excess capacity that they've got in all these products anyway to keep these companies alive.
Absolutely.
Yeah. Okay. So there's that, and then I guess flipping the other way, Cameron's got a question just about saying, well, is there any, I guess the other risk, any risk that Aussie bonds actually do go a lot higher?
Bond yields?
Bond yields, yeah. And I guess that leading into then Aussie dollar going higher as well.
I don't see it. Well, there's always a risk. Like if Team Trump gets it wrong and the bond vigilantes revolt and the US 10-year catapults above 5%, that will drag up the Australian long end. But it'll be doing it chasing the US, so the dollar will fall anyway.
Yeah.
In that scenario, the Aussie, I don't think there's any chance of anything other than rate cuts coming. So the short end should fall. So I'm not worried about that. No.
Yeah, I think your best bullish argument, or the best argument for bond yields going higher, I guess, is that Trump and China come to some sort of deal. He gets Jared gets to run $10 trillion of Chinese money, and there's no tariffs, and everyone's friendly, and NVIDIA's allowed to start exporting stuff.
I mean, that's still pretty dovish, right? Like that's not, that would put the bond vigilantes to sleep. Cheap Chinese goods.
But I'm saying for the Aussie dollar, for the Aussie dollar relative to the
Aussie
US.
dollar, some of that China negativity
comes out of the Aussie dollar.
Inverse premium would come out. Yes, that's true. Absolutely. So, I mean, I probably should have had 6 drivers today because obviously China's very significant where the Aussie is right now. But so I guess have you got any more questions?
No, I think that's it.
So a lot of negatives are priced. I think in the immediate term, the next, I don't know, month, 6 weeks, couple of months, there's a real risk of a short squeeze.
And what you mean by that is the Aussie dollar going up?
Yeah. It's fallen a long way. The US is massively overbought. China team, so the Trump team might get it right. And, you just get it all kind of a bit of a correction back towards normality. That's probably the base case, my base case for the very short term. When you look out a bit further, though, like unless Trump really shoots him in the foot, he's inheriting just a fantastic economy here. Like got all these native drivers. Biden administration did a brilliant job on industry policy.
Terrible job selling it. Brilliant job.
Terrible job selling it, especially in the Midwest, but a brilliant job nonetheless. So there's all these factories being built and supply chain repatriation and all this stuff. And productivity's through the roof with all these productivity drivers, only just starting to come out. American obesity is falling. Can you believe? Like the first time since, like
Forever.
1630. And AI, although hyped in some ways, I think you can see it's going to have a material impact. I mean, I was reading stuff about even poor old Wall Street, which has sold AI to everybody. Hiring's down like 30% this year because they just don't need juniors anymore. They've got ChatGPT instead.
Yeah, and I think I don't want to be too cynical, but I do think there's a certain element within that of there's a lot of deal making that gets done on Wall Street, and a lot of it's like, well, I want to buy this company, and so the deal gets done between the two senior people, and then the senior broker goes back to his team of people sitting there at 11 o'clock at night after he's come back from cocktails, saying, "Yep, the deal's on. Go write me a 50-page report, and slides and all that type of stuff explaining why it's a great idea." And they go away and do that, and then the next morning it gets presented to boards and signed off and everything. And there's nowhere near as much analysis as what you might think. Like it's the outcome's been predetermined. We're gonna buy this company.
Yeah.
And it's all that extra work is now, I don't need 10 people doing it. I only need 3 because they've all got ChatGPT. And so it's not really, you haven't really lost. It's not like you've got AI making decisions in these, but what you've got is you've got it doing the grunt work and
times that by 1 billion trillion, and you end up losing quite a few jobs. So you get quite a bit of productivity out of it. I actually think some of the very impressive cynics about it may be proven wrong. I'm not saying it's the genius that is being made out to be, but it looks utilizable in some fairly practical ways. So I think he's going to have an impact. So in short, he's inheriting a great economy. His main danger here is overheating it, overcooking it.
Yeah. But given we're in a rate cutting cycle, it's pretty hard. We're going in the opposite direction. Oh, sorry, yeah, that's right. But we were going in the opposite direction, and so to overheat it, you've really got to run it much harder.
So bring that back to the Aussie. Once we kind of chew through some of what are pretty extreme positions at the moment, at some point that's going to have to rebalance. I'd probably get negative on the Aussie again, depending on what played out. A grand bargain in China might change my mind or whatever. But sort of moving into mid-year, I think more likely than not that things are starting to get bearish again. And the closer we get to 2026, kind of the worse it gets. The US should still be fine, and China's just not getting better, probably getting worse. Bulk commodities really start to fall just on supply. Like there's a big supply problem from through the second half of this year. It starts and it runs for the next 3 years. And that just presents the Aussie with immense headwinds, especially given we've got such a trashed economy already, like with such weak real income. And then you're going to hit it with an income shock, like a huge income shock over the next 3 years. You're going to need a very low Australian dollar. And I suspect you're going to need much lower interest rates than anybody thinks. Like, if we do get iron ore going to $50, you're going to need interest rates. What are they at the moment? What are they, Damo?
The 10 years at sort of 4.
No, what's the cash rate? I can't remember.
Yeah,
4.35.
Yep.
If you get a $50 iron ore for any period of time, you're going to need a cash rate like down at 2 and under. like way below where anyone thinks it's going.
Yeah.
It will just drag the neutral interest rate much lower, and so I guess what I'm saying is big risk of short squeeze. Short term starts to get more bearish into the short to medium, and then the long is just bad and bearish. Even if you got a good deal between China and the US, and that lifted the Aussie for a while into 2026, and the iron ore glut, it just gets worse and worse.
Right. Excellent. Thanks, Dave. I think we might leave it at that. Just a reminder for everyone, we are on every Thursday, 12:30. If you want any more of this, jump on nucleuswealth.com/content, sign yourself up for our newsletters. You can get us on Facebook, LinkedIn, Instagram, Twitter. You can see us all on all those. And we're on most of the major podcasts. I do need to update this slide. I keep thinking about it every time I see Google Podcasts is no longer there, but yes, Spotify, Apple, and YouTube Podcasts it is now, is all up and running. Thanks, everyone, and we will see